Hello, I'm Sohail Farouk from Banking Book Analytics. Are you shopping around for a best practice IFRS 9 software solution? Are you interested in automating your IFRS 9 reporting? Are you about to embark on CECL or other models development and would like to learn about our firm's modeling capabilities? If your answer to any of the above questions is yes, then this presentation is for you. These are some of the challenges that FIs face, i.e., implementing a complex standard and automation. Our team of credit quants have developed an inclusive cloud-hosted tool that is designed to address implementation and automation challenges for FIs with and without internal rating models. Our tool is available for subscription licensing. Our product's features and subscription licensing make it particularly attractive for small to mid-sized FIs, such as credit unions, investment managers, and smaller banks. So what does our tool accomplish? Before we answer this question, we need to look at IFRS 9 requirements. Under IFRS 9, each loan or a portfolio of loans is viewed through a lens of three buckets. These buckets classify them into stages 1 to 3. Once a loan or the portfolio is mapped to a specific stage, then a corresponding expected credit loss metric is developed. Finally, the expected credit loss metric is adjusted based on a forward-looking criteria, which is then used as the basis to determine an overall ECL allowance. When designing the model, our objective was to develop a solution that is not unnecessarily punitive to unrated obligors and also simplifies the complexity of the standard for uncomplicated institutions. For institutions without internal rating systems, we developed expected credit loss metric both on collective and standalone basis. While it is easier to determine defaults on a collective basis using days past due or roll rate analysis, however, for unrated standalone obligations, this was challenging. To address this challenge, we used the risk-weighted assets assigned under Basel's standardized approach to unrated obligors. For example, Basel assigns 100% risk weight to unrated corporates, which implies an approximate probability of default of 1.2%. Similarly, PDs can be derived for small-medium enterprises, residential mortgages, and other borrower cohorts. We call this implied PD approach. For those institutions with internal ratings, this was relatively simple as we used through the cycle PDs and converted them into point in time. What is our methodology? We used Kaplan-Meier's survival probability function, conditioned on life of loan or default. We determined the life of loan using advanced gamma distribution. For the term structure of PDs, we used Markovian approach and also applied numerical methods such as interpolation. For exposure at default, we organized facilities on the basis of amortizing and revolving loans. For revolving facilities, we use credit conversion factor to determine exposure at default of undrawn exposures. For amortizing facilities, we developed prepayment factor. Finally, to determine the forecasted LGD, we used Black-Scholes option pricing model. What is our data flow logic? IFRS 9 Impairment Analyzer is an Amazon Web Services hosted application. This application is organized in 3 modules. In data input module, we organize data for collective and standalone observations. For collective observations, to avoid historical bias, we look at performing and non-performing loans, including sensor data. For standalone or implied PDs, we use master rating scale or rating agency data, whatever is applicable. Once data is cleaned and input, it is then exported to analytics engine for the determination of expected credit loss. This model provides expected credit loss for each loan or portfolio of loans for all three stages. Finally, based on a user-defined criteria, a specific stage is assigned along with a corresponding ECL metric. This calculation process is carried on until the entire loan book's impairment calculations are determined and collated. Our IFRS 9 solution also acts as a blueprint for current expected credit loss, or CECL compliance, which is the US equivalent of IFRS 9. Our CECL solution is called CECL ALLL Analyzer. CECL ALLL Analyzer is ideal for small to mid-sized institutions, credit unions, asset managers, insurance and securities firms, and is also available for subscription licensing. As a recap, the key benefits of our tool are: it addresses data paucity challenge by avoiding historical bias. It organizes data logic to develop ECL metrics for rated and unrated obligors on standalone and collective basis. Applies Kaplan-Meier survival function conditioned on life of loan or default. Life of loan estimate is based on advanced gamma distribution. Develops forward-looking parameters using macroeconomic forecasts based on a robust Z-score engine. Well, thank you for checking out our IFRS 9 modeling methodology. Please feel free to reach out to us by visiting bankingbookanalytics.com, where you can set up demo appointments, request product brochures, and a copy of this presentation. Sign up for our webinars and also check out other solutions. For a limited time only, we are also offering a free 30-day trial of our solution. Certain conditions apply. In our next video, we will talk about how IFRS 9 predictive analytics can be applied for greater business value. And finally, please do not forget to subscribe to our channel and hit the bell icon so you do not miss a thing. Thank you for your time, and we look forward to speaking with you soon.